Hey everybody, what is up? Welcome back to Funnel Trade. So I have another great question from patron Ryan, and I'm going to click over and just read it verbatim so that I don't miss anything, so I don't mischaracterize the question. He says, I had another question. A lot of people who invest in this space say, quote, before you invest in TCGs, get your employer 401k match, invest in a Roth IRA, pay off your house, etc. While some aspects like getting an employer match and having an emergency, I guess he means emergency fund, are higher priority than investing in TCGs, if you just placed money in a Roth IRA gaining 6% a year, you're leaving a lot of money on the table. Do you have any thoughts on these sentiments, why people say this all the time, or rather how one should think about these issues? So, yes, I would say first, um, employer match on the 401k, it's free money for the most part. I mean, you have to work for the employer and you have to put your money in to get the match. I will tell you, even today, as I am winding down my professional career, I am still getting the full employer match. Like, I pulled back my 401k contributions to that point about a year ago because, well, for reasons I'll get into later in this video. So, yes, go get that because that's extra money to help you save for retirement. On the emergency fund front, that's important too. I have some different thoughts that most people probably won't agree with on the emergency fund, and here they are. So, I started an emergency fund. I had the good fortune of several of the guys who I sat with when I got my first professional job in 2006. They were very, very smart, reasonable people when it came to money, and they kind of, immediately started trying to share those things with me. And one of the things they talked about was, hey, have some cash on the side for an emergency. And as a young engineer, it was like, okay, that's pretty easy because I'm used to being poor. And then I have now this engineer salary. And, my lifestyle did not immediately take a step upwards for that. And so I felt as if now I had all this additional income that I didn't have before, and I still had a poor lifestyle. And so it was very easy for me to start saving. Now, I did that all through, say, 2006 to 2009, which is when I bought my first house. And we used the emergency fund money to put the down payment on the house. And then eventually we would sell that house sometime around 2013 or so and buy the house we're in now and kind of additionally drain off some of the emergency fund money to make the bigger down payment on the more expensive house in 2013 and build the fund back up, drain it down, build it up, drain it down, and never for an emergency, but it was like, oh, my dad has this car that he's going to replace and he'll sell it to me for a reasonable price. And so draw the fund down to buy the car from my dad and then, build it back up over the next, say, 18 months or something like that. And eventually I came to this realization, and there's going to kind of be a theme running through this, which is the extraordinary time period we lived in from, 2009 to 2022, something like that, where we had zero and near zero interest rate policy with very few interruptions. And so I hit this point in, say, the mid 2010s when I could look out there at my emergency fund account and I could say, okay, it had, I don't know, 20 or $30,000 in it. And I would say, now if I lose my job, I've got this to just keep paying the mortgage, keep paying insurance, keep paying groceries and electric bill and all these things while I work into another job. And I started to question, should that money be invested in something? And should it be earning a return? Because cash is melting at 2, 3, 8, 10% per year, depending on the year, depending on how much money the Federal Reserve is printing, your cash is melting. And I started to really think about that a lot in the mid 2010s and think, well, if I can take an emergency fund and instead invest it in the S&P 500 in just index ETFs and I can get on the long timeline 8 or 10 or 12% per year return, isn't that a lot better? And doesn't that much better prepare me for emergencies? And so at some point I did that. I just took all the cash and I put it into my post-tax brokerage account and I bought S&P 500 index ETFs. And that's turned out to be a very good plan. Now, if that's the kind of thing where you hear that story from me and you say, "Oh yeah, that's very reasonable." What I would do is walk into that changed position over the course of, say, 18 months. Like every 3 months, take 1/6 of your emergency fund and put it in the S&P 500. And that will kind of protect you against short-term drops in the market. Because the worst thing that could happen is, the market absolutely crashes, the economy goes to hell. And at that point, you lose your job and that index ETF that you bought is in the gutter. So that's kind of the worst case scenario as you're moving into that position. But when I had that realization in the mid 2010s, it was, I can do a lot better with this, and I don't have to keep the cash if I have it invested in something that we generally regard as pretty safe, which is the S&P 500. I mean, you basically have to bet against the American economy, against the dollar, um, against the American worker, against all these American companies, against our political and cultural dominance of the world. And that's really a bad bet to bet against. Okay. So that's kind of how I feel about emergency funds. Now, if you're 22 years old, you've just graduated college, and you've got your first big boy job, yeah, you probably need to save in cash for a while and build up the cash part of that. And then at some point, maybe you might say, okay, I have $10,000 of cash. And then every week, when you take a little bit of your paycheck and put it in your post tax brokerage account, well, instead of holding it as cash, you just use it to buy your S&P 500 index ETFs. And over time, that builds up and will eventually eclipse that $10,000 of cash you keep in there. And at some point, you would say, oh, let's just take that cash and just throw it all into the index ETFs at some point. So that's kind of my unpopular and different view on emergency savings accounts. And should you have that done before you start investing in TCGs? Yeah, probably. Yeah. Because the way that I think about a lot of these financial issues is I go to the question of, what's the worst thing that could happen to me? What is the catastrophic doomsday scenario? And so, going back to the 401k and getting your employer match on that, I frame that as, what is the doomsday scenario for my retirement? And many years ago, I would say sometime in my late 30s, I started to realize, okay, I've saved very diligently, I've invested well, and the doomsday scenario for my retirement at that point was, well, I worked till 59 and a half, and I have a really good retirement. Because at 59 and a half, you can start pulling from your retirement accounts in the US without an extra 10% penalty. So that was my doomsday scenario. And then in the last several years, since I started Final Trade and I've had a lot of success with it, that doomsday scenario has shifted to, well, I could quit my professional career. I could fail at everything that I attempted up to the level where all I managed to do was pay the mortgage and keep everyone fed and alive. I could fail to be able to save even an additional dollar for the rest of my life, and I would still retire at 59 and a half. And so I think of things in terms of that. And that's why at that point, I pulled back to just what would get me the maximum of the employer match on my 401k. And I didn't put any more in 401k because at that point it was like, well, I really didn't need to. And I've considered at times in just the last, say, 6 to 12 months, just turning off all of my 401k contributions altogether, just so I could pour more money in the final trade. I did the math. I talked about it in a video a couple months ago, but I did the math on Final Trade's history, and my total return on invested capital annualized for Final Trade since its inception in January of 2021 has been 70% annually. And so, yeah, it would make sense for me to stop putting money in the S&P 500 in a retirement account where it's locked away until I'm 59 and a half, and instead shovel it all in the final trade. But again, it comes back to, what is the worst thing that can happen? And, one of the worst things that can happen is final trade one day turns into a giant failure. Everything stops working and it falls apart. Well, in that case, I'd like to have the 401k account to fall back on. Now, to this patron's question, when he says, "Look, I'm seeing the returns." Okay, he's seeing the long-term Pokemon returns. He's seeing the shorter history of Magic collector box returns, especially since WotC fixed collector boxes starting around 2023. He's seeing those returns. He's seeing that they stomp the crap out of the S&P 500, and he's saying, "Why am I investing in these other things?" And there's a particular part of his language that I think is a little bit concerning. He says, if you just placed money in a Roth IRA gaining 6% per year, you're leaving a lot of money on the table. Okay. And that's the part where I say, okay, let's hold up for a second. Let's talk about what it means to leave money on the table. Now, I absolutely understand if you've been around with Final Trade for a while, you've seen the Pokemon long-term box performance videos, and you've seen that Pokemon booster boxes over the course of more than a decade return 20, 25, 30, 35, sometimes higher compound annual growth rates. You might look at the S&P 500 and say, why do I want that boring 8, 10, 12% per year out of the S&P 500? Well, the reason is that that boring increase in the S&P 500 is the product of an entire economy. The entire US economy, where every day, 140 million workers get up and go to work. They accomplish things, they satisfy customers, they build products, they sell things, they have ideas, they register patents, and all the rest. They perform services and everything else in an economy. And so that 8 or 10 or 12% per year from the S&P 500 is backed up by that. Okay. The 20, 30, 40% per year of Pokemon booster boxes is backed up by psychotic Pokemon collectors who frantically shove their money away from themselves in order to rip packs in their car. You may not always be able to rely on that. And so it's not simply that you're leaving money on the table, it's that you're taking a different risk profile. And like I said, my doomsday scenario is I quit my professional career. I fail at everything except just keeping the family fed and housed, and I'll still retire happily at 59 and a half. And so for me, shoving lots of money into the TCG market is not very dangerous because I can just I could go back to an engineering career at some point if I absolutely had to. I mean, that for me that would be like beyond the doomsday scenario. It'd be even worse. But I could. And so you have to be careful about thinking that some very, very high risk investment option and not taking the high risk option is equivalent to leaving money on the table versus the lower risk option. And we can even go further in the other direction. I mean, if you want really, really low risk, you can probably buy 0.5% yielding Swiss government bonds. That's probably one of the safest investments in the world is Swiss government debt. And you could buy that and, well, that would be very, very safe. And you would have to decide how much you feel like something like the S&P 500 is leaving money on the table, taking Swiss government bonds instead of the S&P 500 is leaving money on the table. Where generally we kind of say, yeah, S&P 500 is pretty safe. That's kind of our baseline investment that we all talk about because none of us really expects that the entire economy is going to implode for decades and never come back. So there will be bumps in the road like there always are. There will be recessions, there will be job losses, there will be bankruptcies, there will be all the things that you want to happen occasionally to clean sickness out of an economy, but it's never going to just go to hell and never come back. Okay. So that's why we use the S&P 500 as that baseline. Now, a very, very, very risky alternative investment And not taking that risky alternative is not leaving money on the table. And so, um, and if we wanted to carry that part of the analogy to an absurd level, it would be like saying, well, Powerball's like $1 billion or something for the jackpot, and not buying Powerball tickets is leaving money on the table. And you would say, but Craig, you're not guaranteed to win the Powerball. And I would respond, well, we are not guaranteed that these boxes will continue to perform in the future. We think they will. Everything we can measure today leads us to believe that they will, but we can't guarantee it. And so don't make a bet that will end up so catastrophic to your future that you one day end up in a situation regretting what you've done. And so if you're considering, hey, I should just stop putting all money in a 401k and instead put it all into Pokemon boxes. Well, understand that if you do that, you are accepting a possible future where you work until you die. Imagine you live into your 80s and you have to keep working every day because you're so broke. It could happen. And so make sure that whatever reasonable doomsday scenario you see as a possible worst case outcome of whatever risk spread you want to take amongst all your investments, amongst all the markets, amongst all the categories, make sure that doomsday scenario is acceptable because you might end up in it. So think about it that way. And there will come times when you realize things have materially changed in your life. And typically just a result of getting older. It's a result of saying, oh, uh, when I was in my mid 30s, I said, oh, well, I've built this level of wealth where there are certain doomsday scenarios I no longer have to worry about. And now that I'm in my 40s, my wealth has increased and markets have been nutty for the last several years. And, we came through this insane time of nearly 15 years of zero and near zero interest rate policy. And thankfully, I got to be a beneficiary of that. But now I'm able to say, okay, there's this whole other swath of doomsday scenarios that are now off the table. And so now the kind of doomsday scenarios I look at, like I've said, are hey, I quit my career and all I managed to do is keep everybody fed and housed. And hey, I would still get to retire at 59 and a half, even if I fail to ever sell another card. So think about it that way as you go forward and understand that you really do need to reevaluate these things from time to time, probably on the order of every 3 to 5 years. Really look at, how much do I have in emergency savings, in post tax brokerage, in 401k, in my, my side business? What's my earning potential? All those other things. Look at all of those together and think, okay, now what does my long term financial outlook appear to be, and what are the doomsday scenarios that I still face? So that's the way that I think about it. Hopefully that's helpful. And one thing that really just bears repeating is we had this unprecedented period again from about 2009 to about 2021 or 22. Is about 2022 when inflation hit the peak and the Fed really started raising the rates a lot. And we had a brief period in about 2019 when rates got up into my recollection is 2.5 or 3% for the prime rate. And then COVID hit and they threw the rates all the way back down to zero. But the point being, there was a long period in there where, for the most part, rates were unhealthily low. And a lot of sickness built up in markets and in the economy in general. And not all of it has been atoned for yet. But one thing was if you were invested in assets and not cash at the time, your net worth did pretty well because all of this additional money that was created had to go somewhere and it went into assets. And I really don't expect that to be repeatable in the future. And I know people will say things like, well, the national debt is now so big that even at a 3% prime rate, we can't service it. Oh, well, okay. Um, maybe we default on the debt at some point. I don't know if we should or not, but maybe we do. So I'm not convinced by the argument that, oh, the debt's so high that the Fed will have to keep rates artificially low forever, and then we'll just I print money forever and hope there's no consequence. So we've kind of had this unprecedented period over the last 15 years that I'm not convinced at all will repeat over the next 15 years. So keep that in mind that, you know, if you're my age, if you're in your 40s today, you had the good fortune to live through that period where any accumulation of assets was greatly rewarded by federal, by central bank meddling in the economy and in markets. And I don't know that we'll be that lucky in the coming 15 years or that we want to be that lucky. I mean, it's like I said, it builds up a lot of sickness in the market and you see that in a lot of places. A lot of it is in the real estate market, which is an absolute mess across commercial and office and residential real estate. The only one that I think may not be a real disaster with a ton of built up sickness is industrial real estate. So uh, keep that in mind too, that your assumptions of the last 15 years may not really hold over the next 5, 10, and 15 years. So it may be radically different, and that you always need to consider what the potential doomsday scenarios are that you still face. So hopefully that answers your question, Ryan. And thanks a lot. Thanks to everyone who makes this content possible, especially guys like Ryan. Keep the questions coming. Like, comment, share, and subscribe. Join me on Final Trade. My hat.